I worked at a bank for 8 years at a management level, running money. So I've been lucky enough to be in the belly of the beast, right? So what's happening is the following. US regulation has failed to regulate what they call small banks. Over $200 billion in assets is not a small bank whatsoever, but the regulation was extremely lax, which means these banks, mostly regional community banks, don't need to stick to the regulation that large banks need to stick to, which means they can have a very concentrated funding base and they can mismanage their assets, which is what Silicon Valley Bank did. So then depositors flee away, and all of a sudden you don't have assets that are worth good enough to liquidate to service these deposits. Now, the issue with these small banks is that it's not the Silicon Valley story alone. They might have really mismanaged their risk management style, but the fact that the regulation was so lax on the small banks made the incentive schemes completely misleading, which means if you're a small regional bank, you don't have regulatory scrutiny, you tend to act a bit more like a cowboy. You tend to take more risks because the regulator is not on your back. Now, that means that there will be some more small banks under pressure, but overall, this can risk turning into a contagion event where people lose a bit of confidence in the banking sector overall. Now, that's where we stand. What has the Federal Reserve done is to say, ladies and gentlemen, the value of these treasuries, the value of this collateral, which we are now questioning, because if all banks need to start to fire sale this collateral to raise money to service these deposits, this is going to hit the value of the collateral further. The Federal Reserve has stopped this process by saying, take these bonds, which are worth 80 cents on the dollar, 70 cents on the dollar, David, give them to me with the new bank term funding program, and I'll fund you at 100 cents. No haircut whatsoever. I will ignore the market value of these treasuries. I will fund you at par. So what the Federal Reserve has done is basically put a Band-Aid on the situation and said, if yours is a liquidity problem, you don't need to take haircuts by selling these securities at 80 cents on the dollar. You can post them to me at 100 and I'll give you the money you need. This is a Band-Aid that takes care of the liquidity problem, but the loss of confidence in small banks, in the way they run their business model, David, that unfortunately remains there. And that is a problem together with the credit risk that these banks are running. Small regional banks whose credit is now drying away, whose people are losing confidence towards, are also the banks that lend the most money to the real economy. They account for more than 70% of commercial real estate lending. They account for over 60% of overall real estate lending to the US economy. So if consumers are losing confidence in keeping their money at the small banks, you can expect the small banks also to pull back on lending to the real economy. And this generates a negative loop effect, which makes less credit flow towards the real economy and therefore a higher probability of a recession hitting in a few months. That's where we stand.